I was waiting for these earnings this week. Cloudera, a newer position of mine that I was pretty excited about. It's been going up quite a bit. I mean, I was up 50+% on this position, but after hours, down 10.5% after an earnings report. So we're going to dive into that earnings report and see what happened. It did go up 10% in the normal trading session. So all things considered, it's really not that much down from where it began today at, technically. But you see still a nice run up for this company. When I picked it up around $7 per share, I think, where did I pick it up? $7.60, something like that, somewhere around that amount, right in the mid-7 ranges. It's had a big run up of 60+%. So it's just kind of cooling off a little bit, I think. We'll look at these results. So the reason partially why the stock was up so high today was because of the fact that Morgan Stanley actually upgraded this bad boy to an overweight rating with a price target of $14, which implied a 25% upside from the start of today. Pretty massive there, obviously, that Morgan Stanley get involved with this. It gets investors buy-in. Now, as far as these earnings are concerned, non-GAAP EPS of 5 cents beat by 4 cents, and a GAAP EPS of negative 20 cents beat by 3 cents. Revenue, $210 million, up 12.3% year over year, which was a 5.8 million beat. I did expect a beat. I kind of anticipated a little bit larger of an increase year over year, and a little bit larger of a beat. Not bad numbers by any means, especially a beat on both top and bottom lines. So nothing too bad there. Subscription revenue of $187.1 million was up 21% year over year, versus a consensus of $181 million. So positive stuff, but the shares seem to have fallen. So we're going to get into the fine details here, then we're going to dive into the press release and see what we can dig and find. So revenues grew by double digits, and we're about 3% better than the forecast. As a drop in services revenue, down 28%, was more than made up for by strong core subscription gains of 21%. Annualized recurring revenue rose 11% to $723 million at the quarter's end. You like to see that. Annualized recurring revenue is massive because obviously that's revenue that's coming to them every single year, right? That's recurring, so it's what they always get. It's nice. Nice to have a consistent revenue source. Gross profit rose 24% to $156.2 million. The company narrowed its GAAP net loss to $58 million from a year ago of $103 million, so nearly half the loss that they saw last year, which is a good improvement, absolutely. Very good improvement on that aspect, especially with everything going on, where you see increased expenses everywhere. To see a nice improvement like that is pretty good. Non-GAAP operating income swung to a gain of 17.3 versus a prior year loss of 34.7. For Q2, it's guiding revenue of 206 to 209, which is light of the consensus of 212, and even lighter than this quarter, kind of. I mean, it's weird to think about that. It's lighter than this quarter. They're expecting a worse quarter this next quarter, with subscription revenue of 186 to 189, and EPS of 6 to 7, which is above the consensus, actually. That's probably part of why this stock's been hammered pretty hard. I mean, it was touted pretty well. That's a good growth beast, and to expect revenue not necessarily to show an increase quarter over quarter, it will be year over year growth, but still, you would expect a little bit higher of a gain there. EPS is looking good as far as their guidance is concerned. For the full year, it's expecting 825 to 845 versus a consensus of 860. Subscription revenue is 745 to 755, and an EPS of 26 cents to 30 cents, which is well above the consensus of 24. So I don't necessarily know why they're expecting a lower revenue forecast. I would like to look at these numbers and see what's going on there, but I don't know if it necessarily warrants a 10% dip after hours, because all things considered, I mean, it's still a good quarter for them, but again, I could see investors just trying to cool the stock off if they're not going to be going ahead and posting a very good number. So let's see, non-GAAP. We looked at this. We looked at that nonsense. We want to look at some of these business highlights. Annualized recurring revenue $723.4, which is an 11% year-over-year growth. Gotta love that. GAAP subscription gross margin for the quarter was 85%, which is up 81% from the first quarter. So as you see that subscriptions take over, really, the services revenue declining, subscription take over, that's where you see an increase in that margin for this company, and that's really where you see that path to profitability. And that's kind of what I like about this company, right? You see that shift over, and they get this annualized recurring revenue. This tends to improve their profit margin. It just does. So it's pretty exciting to see how that's going to go for this company. And over the next couple of years, I think there's a lot of potential for this company. Non-GAAP subscription gross margin was 88%, up from 85%. They expanded the partnership with the Google Cloud Platform to integrate CDP Public Cloud with Google Cloud Platform and offer a joint product on the Google Cloud Platform Marketplace. Google or CDP Private Cloud will debut at an upcoming virtual event, IBM and Cloudera, the journey of hybrid cloud and AI, on June 11th, 2020. Maybe investors will buy in then. I don't know. Maybe potentially. They introduced a new MLO PS features and extended SDX to machine learning models as part of our CDP machine learning public cloud service. Pretty cool on that aspect. And 4 Cloudera channel leaders recognized as CRN 2020 Women of the Channel. I guess that's cool, right? I don't know what that has to do with the business necessarily, but that's cool for you. Outlook we saw was light, and it doesn't necessarily give it a reason as to why necessarily that lightness is going to be there. So the business's outlook is based off the assumption that the necessary impact of the pandemic will peak in Cloudera's second and third quarters, which again will be this upcoming and then the following. So their opinion is the impact is going to peak in this quarter and the next quarter, and that's what's going to hurt them. But they're expecting higher EPS and less revenue. I don't necessarily know if that quite makes sense. I don't know. I don't know if that's necessarily the actual estimate that I might give for this, but it's what they're giving, and it might be light guidance, and hopefully they crush it. I mean, there's a good chance that they still crush it. I believe all things considered, next quarter they should easily post over $210 million. I don't think it's necessarily going to be a lot higher than that, but I do think they'll absolutely post that number. Even though their consensus is a little light of that, I think they will post over it. So pretty exciting. And finally, we look at the balance sheet because you got to know what is going to be concerned with this company as far as future growth. How is this company going to survive? It's going to survive by its balance sheet, and it's given me a quarter-over-quarter comparison. So cash and cash equivalents of $160 million on this company versus a quarter ago of $107 million. Total assets, total current assets on this company of $658 million versus $707 a quarter ago. So they definitely spent a little bit there. You see a decrease in the accounts receivable. So they definitely received some of that into their current cash and cash equivalents line. Absolutely. My hope is they paid off some debt with it. Let's take a look here. Total assets as a whole of, that's right, $2.2 billion versus $2.3 billion a quarter ago. I'm hopeful. I'm hopeful that liability line decreases. Total current liabilities of $539 million versus $579 million a year ago. So they did decrease the debt load a little bit as far as current's concerned. And from a long-term basis, $806 million versus $861 million of a quarter ago. So they did decrease overall debt, which is pretty nice. I like to see that, and to see a total stockholder equity of $1.3 billion is nice. Still decreased a little bit year over year, and it's because that negative cash flow is not great for the company, but they're working on improving it. Overall, the balance sheet's good on this company to have twice the assets that you do. Liabilities is always good. The company's well poised for the future, in my opinion. I do think there's a lot of room for run-up on this stock still. I really do. Now, I think you might say that might be a little ridiculous of me, but a company trading at a market cap of 3.6 billion, with annualized revenue of close to $1 billion, are only really trading at 4 times that multiple. I think it's relatively fair for this company and the growth that they can bring, and really just the potential they have for the future. I still think this stock's a fair pickup. I really wish I had picked up a lot more when it was sub $10, and I think really sub $10 is still a good pickup point, and it may reach that for sure. And I had a lot of time to pick it up, but anytime around the $7 range is a mega buy for this company, and I really made the mistake not making that purchase. It's really hasn't had much favor since IPO on this stock, really. I mean, down 31% still total since original IPO release. At one point, in 2019 was down to the $5 range. This year it really only went down to the right around the $6 range. But yeah, I mean, what can I say? 52-week low of 476 would have been a nice idea to pick it up then. But I really am okay with the stock dipping more because it's a position I'd like to have more in. I do think at some point, if you give it by the end of this year, you might be looking at a stock trading around the $15 range. I don't think there's massive growth for this year coming up. 2021, I think, is going to be a big breakout year for them. As we talk about switching over to profitability, 2021 is going to be the key year for them, and I think that's really where the stock jumps. So very excited for the future of the stock, and if it dips below 10, I'll probably be purchasing some more of it. Alrighty, hope you enjoyed.